Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report that smells a bit like fresh asphalt and maybe a hint of financial maneuvering. Get ready because this one has a few curves. This report is from Sterling Infrastructure and it's all about how they're restructuring their debt. Basically they're taking on more debt to pay off some old debt and make some changes. Is this a smart move or are they just kicking the can down the road? Let's find out, and if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come hang out with fellow financial sleuth. This is a Form 8K filing which companies use to report major events. In this case, the big news is an amended and restated credit agreement. That's a fancy way of saying they reworked their loan agreement. The date of the report is June 5, 2025. Sterling Infrastructure, along with some of its subsidiaries, has entered into a new credit agreement. This agreement involves financial institutions as lenders, with BMO Bank NA acting as the agent. This new agreement, dated June 5, 2025, replaces the previous credit agreement from October 2019. It's set to mature or end on June 5, 2028. The key change is that they've increased their borrowing capacity, specifically their revolving credit facility, by $75 million, bringing the total up to $150 million. This includes money for letters of credit, which act like guarantees, and short-term loans are just loans for a specific time period. All this money is going to be used for several things, including paying off old debts, investing in their business, making acquisitions, and for general corporate purposes. They can even borrow more if they need to. The agreement lets them increase their credit facilities. They have two ways to do this. One way is for an amount up to $400 million. The second way is more complicated. They can borrow an unlimited amount as long as they keep their net leverage ratio, which is a way to measure how much debt they have compared to their earnings, below a certain level. In this case, it has to be 2 to 1 or lower. So what's the catch? Well, they have to pay interest on these loans. The interest rate is based on either a base rate or SAFR. It's a benchmark interest rate that replaced LIBOR. On top of that, they pay an applicable margin, which depends on their total net leverage ratio. Basically, the more debt they have, the higher the interest rate they'll pay. The revolving loans can be repaid and then borrowed again, like a credit card. But the term loans have a repayment schedule. They start paying those back in September of 2025, with quarterly payments and the rest due when the loan matures. Once they pay back term loans, they can't borrow that money again. The agreement also includes a bunch of standard rules called covenants. These include things they promise to do, then events that would trigger a default, meaning they'd be in trouble. There are also financial covenants, which are specific financial targets they have to meet. One of these is the total net leverage ratio, which we mentioned earlier increased this ratio to 3.5 to 1 if they are making a big acquisition. The other financial covenant is the interest coverage ratio. This measures their ability to pay interest on their debt. They have to keep this above 3 to 1, but they get 2 get-out-of-jail-free cards. They can temporarily increase this ratio to 3.5 to 1 if they are making a big acquisition. The other financial covenant is the interest coverage ratio. This measures their ability to pay interest on their debt. They have to keep this above 3 to 1. The new agreement gives Sterling more freedom. For example, there's no longer a limit on the size of acquisitions they can make. They've also increased the limits on how much debt they can take on, how many liens they can have on their assets, and how much they can invest. Plus, they removed a requirement that they use excess cash flow to pay down the debt. All other things being equal, the terms are roughly similar to the previous credit agreement. The obligations are guaranteed by their subsidiaries and secured by pretty much all their assets. As of June 5, 2025, Sterling had $300 million in term loans outstanding and hadn't touched the revolving loans yet. This section just confirms that the new credit agreement creates a direct financial obligation for Sterling. Nothing too surprising here. This part is about fair disclosure. Sterling issued a press release about the new credit agreement. They're including a copy of that press release with this report. However, they're saying that this information isn't officially filed with the SEC unless they specifically say so. It's just for informational purposes. Finally, we have a list of exhibits, which are documents attached to the report. Exhibit 10.1 is the actual amended and restated credit agreement, and Exhibit 99.1 is the press release we just mentioned. Now let's take a step back and analyze what all this means. Sterling Infrastructure has essentially restructured its debt. They've increased their borrowing capacity, giving them more financial flexibility. They've also extended the maturity date of their debt, pushing it further into the future. On the one hand, this could be a smart move. It gives them more room to grow, make acquisitions, and invest in their business. The increased flexibility could be particularly helpful in a dynamic market. However, it also means they're taking on more debt. This increases their financial risk, especially if they can't generate enough cash flow to service the debt. The financial covenants in the agreement, like the total net leverage ratio and the interest coverage ratio, will keep them in check to some extent. But if they violate those covenants, they could be in serious trouble. The removal of the excess cash flow sweep is also interesting. It gives them more control over their cash flow, but it also means they're not automatically paying down debt as quickly. This could be a good thing if they have better uses for the cash, but it also means they're carrying more debt for longer. Overall, this debt restructuring seems like a calculated risk. Sterling is betting that they can use the increased financial flexibility to grow their business and generate more cash flow. If they're right, it could pay off handsomely, but if they're wrong, they could find themselves in a difficult financial situation. So what's the verdict? It's hard to say for sure without knowing more about Sterling's specific plans and the market conditions they're facing. But based on this report, it seems like they're taking a reasonably aggressive approach to managing their debt and pursuing growth opportunities. Alright, that's our breakdown of Sterling Infrastructure's latest debt restructuring. What's your take on this financial maneuvering? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.